Baby boomers are the victims of a shocking scandal in 401k plans. They've already lost between 15 to 25% of their savings so far this year, and they'll lose more of it if they don't act now. Stay tuned, folks. You're going to find out more on the Baby Boomer Investing Show. Good morning, everyone. I'm Kathy Tarochione, and this is Ron Surz. We're brother and sister. I'm the one that doesn't know anything about investing. He's the one that does. So, Ron, what are we going to talk about today?
Well, Kath, the topic today is the shameful scandal that's going on with baby boomers and their 401k plans and their individual retirement accounts, their IRAs. But before we get into the wealth part of this broadcast, let's talk a little bit about the health, because it's certainly paramount in everybody's mind. And I thought I'd like I know you're not feeling well, so you may want to talk about that. And
Yeah, I do.
I really appreciate you're doing this. You're a trooper.
Yeah, well, I'm a 73-year-old. I'm in Phoenix, Arizona. I have COPD and congestive heart failure. And for the past week or so, I've been having a headache, a fever, sore throat, congestion. And of course, like anyone would, you'd fear, oh, I've got the coronavirus. Well, I tried to be able to get a test of any kind, and it was a fiasco. So the fear entered in, thinking, wait a minute, I have to go into all of these places where there's a lot of sick people, meaning to the labs, to the doctor's office, etc. And I'm already sick. So am I spreading it to someone else if I do have the virus? So I was feeling kind of guilty. I had my hands over my mouth. I had a handkerchief. And I got to tell you, when I was in the lab place, there wasn't one single person that did the elbow sneeze or cough. They just coughed, and I'm, what? Nobody's listening to this. So the health part of it is scary enough, but then knowing that your finances can be affected, it's stomach turning. It's almost like riding a roller coaster. So I know personally, I'm scared. I'm very, very scared, and I think everybody else should be too. So.
Yeah. Absolutely. The wealth effects spill over into the health effects too, because we know stress is not good for anybody. So it's really compounding. But just to put it in perspective, right now there's 200,000 people officially who have been affected by the coronavirus health-wise, but millions who have been affected by it financially.
Oh, so, good point. Yeah.
I mean, there's a lot more people who are hurting financially, and so that's what this show is about. And I don't want to minimize the health concerns; they're definitely there. Like you, so you guys know who are listening to this, we're brother and sister, and we're both boomers, and we're doing the Boomer Show. But what I'd like to talk about a little bit is what's going on financially and what the scandal really is. So stock markets so far this year are down about 25%, and that's terrible. In 2008, total between 2008 and 2009, they were down close to 50%. So we're not nearly as bad yet as we were then. And the scandal is primarily in part of the 401k market called target date funds, where fiduciaries are involved, and the fiduciary is supposed to put you in a target date fund that especially protects you as you're near retirement. And so far, target date funds, 2020 target date funds, which are for people who are retiring around this year, they are down about 15%. Target date funds for younger people are down closer to 20%. So you can say, well, 15%, I was protected. Well, the fact is, if you had been listening to our previous shows, we're creating a foundation here, and if you had followed the tenets of those shows, and if target date funds were following those tenets, you wouldn't have lost any money this year so far, which is amazing. You might have been down maybe as much as 1%. The same thing is true for individual retirement accounts, where many people in individual retirement accounts are using advisors who should be fiduciaries. By the way, if you're not using a fiduciary, that you need to be very careful. But those are also down for older people, at least 15%. So this show is all about the harm that's already been done and what you can do to learn from this harm and hopefully get out of the way and correct it in the future. So why don't we?
Whoops. Oh, Ron. Oh, I'm sorry. I didn't mean to do
Oh,
that.
wait, don't start the show. I want to do something else first.
Okay.
If we could.
Yeah, we started talking about this at Christmas time.
Yeah, exactly.
Yeah.
So I want to give the listeners a little background. So Kathy is an expert on Facebook, and she's got a very nice show on dogs. It's called The Dog Connection, and she knows what she's doing. And at Christmas time, we were just talking about her show and its success, which is great. So if you love dogs, I highly recommend The Dog Connection. And then we started talking about my concern about our fellow baby boomers and how I could just see it. I could just see it on the horizon that people our age are going to get totally burnt. And I don't think they see it coming. Many boomers are relying on other people to make decisions for them. And that's where the scandal is. So we're going to talk about that. But so we decided at Christmas time that Kathy would help me because I had known nothing about Facebook.
Yeah.
And we would do these videos.
Yeah.
Yeah.
Well, what I
And
was going to say is that the people that you wanted to reach, I was saying, Ron, you have a gift. You know how to communicate. You know you have a solution for these people. And just on all the work that you've done through the years, by the way, my brother's very modest. He never talks about all the credentials that he has in that, but trust me, folks, he knows exactly what he's talking about. And especially when it comes to baby boomers, because he's one too. And he protects his own assets as well as watches out for all of his family and friends. So it's a real important thing that he's doing in sharing this. And when people watch these shows, they think, oh, where's the hook? We're trying to sell something. And true, there are areas where you could get some kind of help. And there is a cost for that. Of course, everybody doesn't do it for free, but most of the work that he is doing is giving it the information to you so that you can make your own informed choices as to your own financial situation, which if you're feeling comfortable financially, then you should be feeling better health-wise.
Absolutely.
So that's an important thing. I just wanted to put my 2 cents in there.
No, thanks. I should have mentioned. I'm old. I'm sorry, go ahead.
Kelly says, good work, Ron and Kathy.
That's great. So I was a pension consultant for 50 years and consulted to trillions of dollars, mostly in institutional assets. And lately, I've more turned my attention to individuals. And that's really the transition that's going on here. So just by way of background. So let's do the show. Okay,
let's do it. Folks, if the gods of technology are with me, then we're going to share the screen. And here we go. There we go.
Yeah, so our topic today is the next 401k scandal. And maybe some of you didn't even know that there was an existing 401k scandal, but there is. And it has to do with excessive fees. And we're going to talk about that first and just describe what went on there and how it's being resolved. So these scandals, once they're identified, tend to go away. And I'll tell you exactly why they go away. But sort of a sub theme that we're going to talk about today is investors, especially individual investors, can benefit from the wisdom of target date funds, which we're going to talk about, but they can benefit from it by building their own. And there are tools that you can use to do that. And I'm going to show you why you would be better off, rather than taking something off the shelf, creating your own target date portfolio. So on the next slide, Kath, what I'd like to do is just tell people that we're building a foundation here. And this is our 4th show. And it's sort of like, I think, tuning into a streaming video TV. If you go into one of the episodes, you're not going to know the characters and the background and all that other stuff. So if you feel sort of lost here, I would really encourage you to go back, go to our YouTube channel and look at the first 3 episodes, because they really set the stage for what we're talking about today. So the first episode we talked about smart to do-it-yourself investing, and in particular, the 4 pillars of smart investing. And they are to establish reasonable objectives, to be actively controlling your risk, to diversify as much as you can, and to control your fees. And with those 4 pillars, you can do something really good and smart for yourself. Then in the next show, we got down to the risk thing, and we really focused on managing your risk. And we talked about the 10 threats that are out there right now. The thing with baby boomers is they are in what's called the risk zone. And that's the 5 to 10 years before and after retirement. And at that time, you've pretty much are through saving, and you're about to be spending. And if you were to lose that savings, that would be catastrophic to your lifestyle. It probably could dramatically shorten the length of time that your assets will last, so you might run out of money. And in that show, we identified 10 threats, and I wasn't calling the market turn. I wasn't saying, next month the markets are going to crash or anything like that. All we were saying is, here's these 10 things, and they're all capable of crashing the market, all 10 of them. And I don't know when they're going to happen. Maybe some of them will never happen. But sometime in the next decade, pretty good chance at least one of them is going to happen. And surprise, surprise, one of those things was the coronavirus. And we did that middle of February.
Before it was even a big thing.
Well before. So far we got one right. there's still 9 unders hanging out there. And what we did in that show is we said, you're taking too much risk. So the typical baby boomer is about 60% in equities. That means U.S. stocks, foreign stocks, real estate, things like that. And that is too risky for most baby boomers. And that mix lost 30% in 2008. So that's sort of the proof that's too risky. But it is what it is right now. And so we got responses saying, so why is my advisor telling me to take that much risk? And are they wrong? And we did the third episode then. And basically, we wanted you to understand the history of consulting, the history of financial theory, and why 60-40 is such a bad answer and so entrenched in the industry. And we concluded that show with an epiphany. So the consulting industry and the financial industry discovered this notion that really has changed things in 401k plans, but has not yet changed things with individual investors. And that notion is risk capacity. And what that means is there are times in everyone's life when they are limited in the amount of risk that they should take. And I'll back step a little bit. So when you work with an advisor, they're going to help you establish your objectives. And actually, that's one of the pillars for smart investing. Know what your objective is. In certain situations, you're going to want to do things like leave a lot of money to the kids, get a nicer house.
Donate.
You might want to give it away. And the advisor will work with you, and they'll say, great, let's figure out how much you need to save and what you need to earn on your investments. And they will try to find a portfolio that has the reasonable expectation of earning the return you need. Now, the problem with that is that for fairly reasonable, not that aggressive kind of objectives, you might need like a 10, 12, 14% rate of return. And the advisor will go, fine, we'll put you in the 12% model. You're going to get 12% if you really need to do this. What they should be saying to you is, at this stage in your life, you cannot afford to take the risk that it would require for you to strive for a 12% rate of return. We need to talk to you about lowering your objectives. We basically need to talk to you about being safer. And by safety, I mean, just to put some meat around it, I mean no more than 30% in equities, about half the risk you're taking right now. Oh. The risk zone. So you may feel like right now, because the market's down and what we're really advocating right now, I've written an article that's gotten a lot of reads, that instead of fearing what's happened now with the losses, what that's sort of done is a favor in lowering your risk. Right now, your risk is lower, believe it or not, because you've got less equities. The equities are worth less. So maybe you should be thinking about not so much buying, but keeping that risk level the same, which would probably mean trying to sell into the next rebound if there is one. Hopefully, there is one. So that's sort of like the analogy would be: you get sick and you lose a lot of weight, and you say, "Wow, I'd like to keep that weight off."
Yeah,
So I'm going to use this
I can
as the
relate.
beginning of my yeah. So I'm going to use that as the beginning of my weight loss program.
Yeah.
So that sort of leads into this. So we left the third episode with this innovation that's called the target date fund. And what target date funds do, and we're going to show you that in a couple of slides, but they take into account this inability to take much risk as you're about to retire, but they're not doing enough of that. And that's what we're going to talk about in terms of the scandal there right now that happened in 2008 and it's repeating again. But let's lead into a little background on the next slide, Kath, about where the money is in terms of people's savings. So this data is actually as of the beginning of March, so it's changed a little bit because the markets, of course, have gone down. But the individual retirement accounts have about $10 trillion in them. 401k plans have $8 trillion, and that's the money that individuals are responsible for investing. And that's a big change from the way things were 20 years ago. In the old days, most of the retirement assets were in what's called defined benefit plans, where the employer would make a promise to pay you basically an annuity. And those were very, very nice. And people who are fortunate enough to have those, they're lucky. They're very lucky. So there's not much of those left. There's about $6 trillion in government defined benefit plans, but a lot of that data. So this, whatever. I'm not going to talk too much about that. And a little bit in the corporate plans, about $3 trillion. In terms of the 401k assets, they've grown like crazy, replacing defined benefit plans. And they have grown over the last 15 years from roughly $4 trillion to double. They've doubled to $8 trillion. And target date funds have grown along with them. So 15 years ago, there was really nothing in target date funds. And today there's $2.5 trillion. And what's going on there is many people in 401k plans, and maybe you're in that group, don't know much about investing. By the way, Will Rogers said everyone is stupid, but about different things. So you should never feel bad about not knowing anything about investing. So you say to your employer, I don't know, and that's called a default. So you default your investments to your employer, and that employer then needs to decide what to do with your assets. And there are 3 approved things that the employer can do. The Pension Protection Act of 2006 established those 3 things. And one of them is a target date fund, one is a balance account, and the other is having a professional investment manager. By far, the target date fund is the most popular. And I'll show you on the next slide what a target date fund is. So what I'm showing you here is my patented design. And what a target date fund does is when you're younger, the horizontal scale here is years to retirement. So on the far left is you got 50 years before you're going to retire, so you're young. And on the far right, it goes to 0, so you're about to retire. And for young people, you put a lot of money in equities. You're fairly high risk. And then as the beneficiary gets older, you start to get a little more defensive. And about roughly 15, 16 years from retirement, the typical target date fund, and my patented design as well, is about 75% in equities and 25% in bonds, and actually 25% in bonds. Then in the last 15 years, my design moves fairly quickly to really protect and guard against losses like the losses we're having now. And it's been my opinion for as long as I've been doing this, I've gotten the target date funds about 12 years ago, that is the right thing to do. That if you're going to protect people, you need to get serious about it, not compromise. The industry, on the other hand, and this is where the scandal is, moves from roughly 75-25 down to only about 60%. And so the risk is still 60% in equities. And the other complicating part of that is most of the balance of your portfolio near retirement is in risky long-term bonds. So you're still, if you are in a target date fund, taking a large amount of risk. So that's the background. Let's switch this for a second to the current scandal and what's going on there. Next slide, Kath, please.
Okay. I need that cue.
I'm sorry. Okay.
Okay.
So there was a really big scandal regarding excessive fees. And this started a good 15 years ago. And there were books written. The thing on the left, the 401k ripoff, documented all the hidden fees and how much people are really paying to have their portfolios run in 401k plans. And it was outrageous, but nothing happened. Nothing happened. Then there was a TV show, I want to say 2003, 2004, public broadcasting, Frontline, called The Retirement Gamble. And it was a wonderful show and did sort of the same thing the book did and showed where how people are paying way too much for their 401k plans. Nothing happened.
Huh.
But what finally did happen about 5 years ago, on the next slide, Kath, there's this attorney. His name is Jerome Schlichter. He's out of St. Louis. And he made it his life's ambition to fix that scandal. And you might say, well, he's just motivated by getting fees. And that really doesn't, because in this case, I think lawsuits maybe are the only way that these abuses ever get fixed. So he's actually so far succeeded in garnering settlements in excess of $150 million. So he's got class action lawsuits that go after fiduciaries who are paying way too much. And one of the obvious scandals that has come up, in many cases, it's really obvious. So you have these pension plans that are hundreds of billions of dollars, and they're using mutual funds that are designed for retail investors. So maybe they're paying 1.5% to the mutual fund provider, when there are mutual funds available for institutional investors that pay much, much less than that, maybe 0.2% rather than 1.5%. So that's the low-hanging fruit for Jerome Schlichter. There are other more subtle abuses, but the key thing is he's had a big success. The estimates are that he's saved investors north of $2 billion. And sort of the moral of this story, I think, is there are carrots and sticks, and the carrots are fiduciaries to do their best. And I think most fiduciaries are well-intentioned, but maybe not paying enough attention to their 401k plan. So now I'm coughing. I probably have the corona. I don't know.
I was going to say, you want to take a minute to get a drink? Yeah, why don't you take a minute? Yeah.
I got my tiny mug here. So
Yeah, right. That's okay. Better?
But the sticks work. Yeah, I'm better. Thank you. So the sticks work. And I want to show you on the next slide why it's important. And I think I know we did this in the previous show as well. So there will be a 401k scandal, and hopefully, well, maybe there won't be a lawsuit, but I think that might be what it takes. And the importance is on the next slide. So this was in the previous show. We all have this life of savings and spending, and the red line here is our savings. So during our working life, the savings build up, and then when we retire, we spend that. And in this critical time period between working life and retirement, that's called the risk zone. And if you Google the risk zone, you'll find a lot of stuff written about it. You'll also find this thing called sequence of return risk, which is a little nuancy, but the idea is you really care a lot about when you lose money. You don't care so much during your working life or when you're deep in retirement, but during this critical time when you're transitioning, you care a lot about losing money during that time period. So what you really want to do, and what fiduciaries and your advisors and fiduciaries should be doing for you, is protecting you. And I call that the risk of ruin. So there's always the risk of loss in whatever you invest in. But during this risk zone, there's the risk of ruin. So what it really deals with is your risk capacity. You have very low risk capacity in the risk zone. And on the next picture, we're going to talk about setting objectives and your risk capacity. So target date funds have a real benefit, and I'm going to encourage you to be in touch with that benefit. And the benefit is to recognize that you have diminished risk capacity in your retirement. And sometimes you're going to need to just lower your objectives. And this is the time when you would do that. So to strive for baby boomers, most of who are in the risk zone, they really need to be thinking, at least for now, to lowering their objectives and playing it safe, and not taking much risk. No one should take substantial risk in the risk zone. So what I'm going to show you now on the next slide is the scandal. And this is horrifying. And again, I've been consulting for 50 years, and I've never seen anything like this. And what's being shown here on the left-hand side is this industry with $2.5 trillion in it is mostly going to just 3 companies.
Wow.
Vanguard, Fidelity, and T. Rowe. So it's an oligopoly. And an oligopoly basically is when a small number of companies control the whole market. And these guys control more than 65% of the 401k, of the target date space. Nothing is good about an oligopoly for the consumer. It can only be bad. So what's going on here, and this is really the scandal, not for Vanguard, T. Rowe, and Fidelity. They're doing a great job marketing and getting all that business. But what's going on here is pension consultants feel that they are taking a risk in advising their client to use a target date fund that is not one of these 3. Now, that's scary.
Yeah, that is scary, and that does make sense, though.
Yeah,
that makes sense that'll happen, because they feel that, well, that's safety. That's where everybody else is. That's the fear of missing out thing.
It's a business risk, and there's also this thing called procedural prudence. And procedural prudence says if you do what everybody else is doing, that's fiduciary insulation. But there's a counter thing to that called the duty of care. And the duty of care says that you really need to try to do the best. So this is a self-interest thing where the fiduciaries have a self-interest to not be sued, and they think that hiring the big 3 gives them that insurance. But then they're not what's called vetting. They're not really doing their due diligence. So as these are 3 really good firms, but their target date funds are not the best.
Mm-hmm.
They're just to put it where I live every day. There are much more prudent target date funds that never even get considered. They're not even talked about. So there might be a maverick that gets into a search for a target date fund, but generally it's just these 3. And then there's a subsegment of the target date fund market called the passive segment, where all the assets are in index funds. There's no active managers trying to beat the markets. And Vanguard has a monopoly on that. They basically own the target date fund segment that is passive. By the way, that's the low cost segment of the market. I'm sorry, go ahead, Jen.
No, I was going to say that's scary. That's very scary, because you look here and you see 28%. Now that combines the other 2 top guys, so that doesn't leave very much for everyone else. No,
it's everyone else is scrambling for the crumbs. And that's just the way it is. Now, the even worse thing is on the right-hand side there.
Okay, I'm going to enlarge this a little bit. There we go.
So this is a graph you need to walk you through. So on the horizontal scale, it's number of years to retirement. So on the far left is 50 years, and the far right is when you've been retired for 30 years. And then the red box is the risk zone. So it's the 5 years before and after retirement. And then the vertical scale is the amount you have in equities. And that's sort of a measure of risk. But being in long-term bonds is risky as well. And the things that I'm showing here are what are called glide paths. So you can see the Vanguard, the T. Rowe, and Fidelity glide path. And they're a little different before you get to the target date and a little different after the target date. So they're not all the same, which is good. But near the target date, this is the crime. They're all about 60% in equities. And they all lost about 30% in 2008. And it's going to happen again. So that's the scandal. Nothing was learned from 2008. The industry is just these three firms. All three of them are taking too much risk at the target date. And I want to, on the next slide, sort of show you that this isn't just in target date funds, it's also in individual retirement accounts. And this is just an incredible thing that I don't think most people know. But listeners to this should look at their own IRA and see if I'm right about this. So the Employee Benefit Research Institute, EBRI, puts out this report about how investors in individual retirement accounts are allocating their assets. And in that report, they show that people who are 20 years old are investing about 60% in equities. And people who are 40 years old, about 60% in equities. People who are 60 years old, about 60% in equities.
Well, that doesn't make any sense.
It makes no sense at all. So what's going on here?
It's a cookie cutter.
Yeah, well, the 60-40 rule is so entrenched in investment advice and what consultants feel is sort of a safe place to go for everybody. So we're seeing 60-40 here. And target date funds are different, as you can see. They're definitely riskier for younger people and definitely safer for older people, which makes a lot of sense. Mm-hmm. But the telling thing here is if you're an IRA and whether you have an advisor or not, and you're in this risk zone, you need to move. You need to get out of harm's way. And this wake-up call that we're having now with the coronavirus, may go away. And a lot of people are thinking it's going to be short-lived, and I hope it is. But please use this as a wake-up call and get yourself to safety. Now, the next slide sort of talks about, so my view, and I've written a lot about risk capacity and why boomers should not take much risk and they should be very, very safe. But the interesting thing about that is that that's just my view. But there have been these surveys, two surveys in particular in the last year. One was by Mass Mutual, where they did a survey of plan participants in 401k plans. And the survey response was, they asked them, how safe do you want to be when you're younger? And they said, I can take a lot of risks. So the orange line over there is saying, take a lot of risk. But as they got close to retirement, the majority of people said, even the young people said, when I get older, I don't want to take risk. And the older people definitely said, I don't want to take risk in the risk zone. And what happened in 2008, and I don't think we've learned the lessons we should have learned then, is the beneficiaries were totally shocked that they lost 30%. And there was a public uproar, and it created the first and only joint hearings of the SEC and the DOL in June of 2009, where they got together and they said, now how can we fix this? What's wrong? And there's all sorts of proclamations and everything else. Nothing happened. Nothing happened to change it.
Oh, boy.
In fact, target date funds actually got riskier. Then the other survey, Kath, on the slide.
Okay, wait, let me go to the next one here.
No, the same slide.
Oh, okay.
So Pacific Investment Management Company, PIMCO, did a survey of consultants, not the participants, but of consultants. And lo and behold, those consultants had the same preferences as the beneficiaries. They wanted to protect the beneficiaries in the risk zone. So there's a total disconnect going on there. If you ask consultants what they think about the appropriate risk for participants near the risk zone, they say very, very safe, but they are choosing target date funds that are not safe at all.
Yeah.
So again, both surveys came out the same way.
Wow.
Crazy. So what I'm also showing here, this is a little commercial, but I don't want listeners to this to think that there are no target date funds that are listening to this. There is one, and it's the one that I've managed for the last decade. It's called the Smart Target Date Fund Index, and the letters SMART stand for something, but I won't get into the acronym. But so there's a live target date fund that, frankly, is not, the 2020 fund has not lost any money this year. So it's just really adhering to this discipline of protection for people in the risk zone. So now I want to start to get onto the advice part of this. When people who watch the show, they want to know what to do next, and we're going to talk about that.
Can I ask a question
No,
here? Okay. All right. So what you're saying is that in this now, if I'm a young person, I say, okay, I want to take a lot of risk, but when I get older, I don't want to take a lot of risk. And you're saying that these advisors are going ahead and anyway putting them at risk.
yes.
Well, now that's I don't like that.
Well, that's what our third show is all about too,
Yeah,
Kathy.
yeah, right.
So this hi Sebastian.
Uh-huh.
So this excessive risk has gone on for reasons that are understandable, but this innovation, this epiphany that happened about 15 years ago about risk capacity,
Uh-huh.
this has not yet gotten fully integrated and embraced by the advisory industry. And that's why we're reaching out to boomers and our fellow a lot of boomers and saying, you've got to take control of this. You need to
Yeah.
protect, you need to defend yourself because you're not getting it.
Well, Ron, I think that a lot of people say, oh, well, I don't want to upset my advisor. We've been friends for 20 years and yada, yada, yada. And, oh, I don't want to cause any conflict. Everything seems to be okay right now. So they don't want to take that step.
Yeah. And I understand that. I've had just anecdotally, I had a friend who asked me to look at his portfolio, and I told him he was taking too much risk. And he said, well, my advisor is my son's godfather.
Exactly. Yeah.
So that's not going to change.
Yeah.
And I totally get it. But I'm hoping enough people will
Well,
take this to heart. If they wanted to have their advisor watch my show and send me hate mail,
yeah.
I guess they can get off the hook that way. At the end of this, I'm going to give some suggestions about how boomers can get some guidance. But first, I wanted to drill down a little bit and say what they should be thinking about. So on the
Next
next
slide.
slide, yeah.
Okay.
So one thing we haven't said yet that isn't an issue of risk capacity and not defending enough. One of the shortcomings of target date funds, even though there's $2.5 trillion in target date funds now, what the industry is now trying to grapple with is the fact that the target date funds are one size fits all. And there's nobody who's denying that there are many people who are in a target date fund who are not like any of the other people. They are unique. They have special circumstances. They shouldn't be grouped together. So this one size fits all thing is a real problem. And that's where the industry is focusing right now. But the focus is wrong. I think that the first focus should be on solving this excessive risk problem. And part of what I think is going on there is changing that now would be sort of an admission that it was wrong before. And that's quite an admission. So I think what it will take to change the excessive risk will be lawsuits, just like the excessive fee thing was not going to change until Schlichter got involved. So the one size fits all is the biggest problem, excessive risk. The other problem in target date funds that I haven't talked about, but I'll just say it, most of them are mostly in U.S. stocks, so there's not the diversification that you should have. And then fees could be even lower. Now, this success of Schlichter in his lawsuits have resulted in the fees getting reduced substantially, like about half. So the average fees years ago, before Schlichter got involved, were around 1%, 100 basis points. Now they're 0.6%, 60 basis points. So that's a good thing. So what I want to talk about is setting your goals and what you need to do for yourself. On the next slide.
Cookie cutter.
Oh, yeah, I'm sorry. Yeah, I don't know what I was thinking. All of a sudden,
It's okay. You're a senior. You're
yeah, I
allowed.
know, right,
Another senior moment. I get them all the time.
right. So what we talked about in the third episode, and what advisors are doing for their clients, um, that most clients don't really appreciate, is when you go for advice, advisors already have these models sitting there, and many of them use what's called a TAMP, a turnkey asset management platform, which means somebody else is doing the models behind the scene for them. And they will sort of, and what's going on in the right hand scale thing there is that the risk is on the horizontal scale and the return is on the vertical scale. And they will sort of mostly work with you to set an objective. And the example I just used is if you have stuff you'd like to do that's going to require you to earn 12, 14%, they're going to tend to put you in the high risk model. But that totally ignores the risk capacity. So just be aware that that's going on. And here's now I'm going to tell you on the next slide what you need to do to take control. And what you really need to do is to the discipline of a target portfolio and control your risk. And when you're in the risk zone, go to a lower risk level. And what I'm showing you in the yellow line here is the typical target date fund. And sort of highlighting 3 decision points. A on the far left is where you would be when you're pretty young. And 100% is probably pretty excessive, but so you need to decide what you want to do there. And 100 would be too high, but there's a starting point. Then the next key threshold is in the middle when you're about to retire, and that's point B. And a typical target date fund is 55% in equities, but also mostly long-term bonds. And then finally, the third decision point is where you want to be when you're 80, 90 years old. And that's point C. And the typical target date fund is around 45%. So not much leveling off in retirement from 55 to 45. What I'm recommending, and that you build your own portfolio, is for the younger participant to take the risk. But when you're in the risk zone, be very, very defensive. And I have a B prime there. There's a placeholder. It's got 10% in equities, but certainly no more than 30% in equities as you're about to retire. And then once you're through the risk zone, you can start to re-risk. And there's been a very interesting study that makes a lot of sense of that. It was written by Dr. Wade Pfau and Michael Kitces, who are very thoughtful researchers. And they advocate this. And they basically say, start out your retirement very safe, maybe, well, again, no less than 30% in equities. But then as you get through the risk zone, you can start to take a little more risk to extend the life of the assets. Now, this is sort of counter to the old rule of thumb that you should invest 100 minus your age. It's sort of close to that when you're 60, so that would lead to a 40% equity allocation. But instead of continuing to lower your equity allocation, you would actually increase it. So we're learning here, and there's been 70 years of evolution that we talk about in the third episode, and it's led us to this sort of distinction. So on the next slide, I talk about something we put together that, so I put this show on SlideShare, and you won't have any problem finding it.
There's a link. I put the link in the description.
Great.
Of the show, so people can go and look at it themselves and click on the links.
Perfect.
Okay.
So if you open this up, this particular slide has links to articles that sort of help you just realize the importance and wisdom of having your own target date portfolio, not a fund, but building your own. And those life challenges, I mean, they're the obvious ones. How should I invest? How can I protect my savings, especially when you're in the risk zone? How can I make my savings last once you're in retirement? How do you do that? And then, of course, the bottom line is, what proof do you have? So I'm asking you to read these articles. And you're going to read them and you're going to say, so who is this guy and what proof does he have? In that article about the proof, I've been running target date funds for the last decade and have a live track record, and that's the proof. I can show you how those have done. So,
Ron, can I ask a question here? So now,
sure.
how many baby boomers actually know all this stuff, or do they just rely 100% or 50% or 80% on their advisors just to handle it all, and they don't even get involved?
Well, there's 78 million baby boomers, and many of them are bright. So I don't really have a hard number, a documented number, but my guess is that at least half of them,
Yeah.
really have no financial education. And oh, you remind me to mention something because I was going to do this later. But on our next show, we're going to have a guest, and his name is John Lohr, Lohr, and he was the corporate counsel for E.F. Hutton, and then started a firm called Lockwood that some people may know about. But he's taken on a charitable mission to educate people. So it's about financial literacy.
Perfect.
Yeah. So John is going to talk about that, and for people who feel comfortable and know what they're doing, that's great. But if they're looking for help, John has really devoted himself to educating people on investing, not just baby boomers, but everybody. But he's going to be our guest on the next show in a couple
Oh,
of weeks.
that's great. Well, see, all of a sudden I'm sitting here and I'm thinking, it's an easy thing to do, but a lot of people just think, oh, I don't want to do that. Just like going to a doctor, you never challenge a doctor. You
Right.
just go along and agree with it. Not me. I'm on the internet. I do the research. I want to know everything there is to know about it, but I'm far and few between. Not that many people do that. So really, this show is helping people to take action and take control of their own financial situation.
Absolutely.
Okay. All right.
Yeah.
I got it. I got it.
Yeah,
Yay.
so like I said, there's a reason to celebrate. We're going to celebrate on the next slide.
Okay. All right.
So, hooray!
Yay.
So, the benefits of doing your own target date portfolio is just you customize it, you build it yourself, and you can change it. So you're not sort of wed to the glide path you originally sent out. And importantly, what you want to do is recognize that your risk capacity is very limited, and there's only this risk zone. You should be broadly diversified, and you're in control of that. But I'm going to show you ways where you can, believe it or not, you can get very broad diversification. And by broad, I mean U.S. stocks, foreign stocks, real estate, U.S. and foreign bonds, and defensive assets for as little as what's called 3 basis points, which is 0.03%. To put that in context, if you had a $100,000 portfolio, it would cost you no more than $30 to manage that portfolio. So,
as compared to what? What does it normally cost?
Well, 60 basis points for a typical target date fund. So that would be $600,000.
Oh, okay.
I'm sorry, $600.
Yeah.
I moved the decimals too fast. So it would cost you $600 instead of $30.
Okay. So big, huge savings on the
Big savings.
yourself. Yeah.
Yes, right.
Okay. Next slide.
And then I just want to reinforce before you summarize. Next slide, please. What you really should take away from this show and all the other three shows that we've done is if you're in a target date fund, by the way, you could be in a target date fund in your IRA. There's no reason why you couldn't. At least take a look at what your current allocation is. And if you're in the risk zone, and I'm right, it's around 60% in equities, you should get out of the target date fund. Now, if you're in it in a 401k, it's because you couldn't make a decision. And that's probably going to be really, really hard for you to make your own decision. But you need to, because you're not going to be defended and you're going to be taking way too much risk. And if you have an advisor, you should certainly trust, but you should also verify. And I'm going to give you a couple ways to do that on the next slide. Let's just go to the summary slide, Catherine. So I'm a little reluctant to even talk about this, but on the other hand, when we started to do shows where we just ended on the previous slide, we were getting people that said, "So thanks a lot. Now now I'm worried, but I don't know what
I
to
don't know
do."
what to do. Yeah. So help me. So we're doing
Exactly.
this. Yeah.
So there's a couple ways that we can help, and you don't have to use them, but we're there for you. One is basically a website, and we call it 8 Sage Robo. And if you Google that, you'll find it. It's interesting. It comes to the
There's a
top of
link
the Google search.
there's a link in the description.
Good. Okay. So if you go there, you can tell the website what your situation is, and it will show you a well diversified portfolio that follows my patented glide path, and you don't have to use that portfolio, but at least you'll have a sense of, or another sense of, what I'm talking about, how to build your own portfolio. Now, that's not free. It will cost you $50 to get that.
Ooh. Yeah.
What I don't want to do is give it away, because if I do, you won't respect it,
Yeah.
and so it's not costing you much.
Yeah, but it gives you an opportunity to find out exactly where you're at, and without having to spend that $600 with your
Exactly.
financial advisor. So it's a way for you to do
Well,
it yourself, folks.
right. And the other thing is, if you're wondering, are you taking too much risk or not enough risk, you'll have sort of the place point to sort of make that assessment. The other thing that we offer is advice. So we will give you advice, and to see our story, and decide if you want to take our advice and use our consultants. You would go to Glide Path Wealth Management, and there we work with a firm called Janney Montgomery Scott, and they're a well-established firm, been in business for, I don't know, 100 years, a long, long time. And you could read the story there and decide if you're comfortable. You could also use it as sort of a cross-check on your current advisor. And then the last thing is, we're going to continue to do these shows. So please stay tuned. In 2 weeks, we'll be having our first guest.
Yay!
And I think for a while now, Kath, we'll probably start inviting guests and guests. One of the conversations I had lately was someone who wanted to go more into the planning side of it rather than the investment side. And they wanted to know, should they buy long-term care insurance? How much do they need to save? How do they know how much they can spend? Those are all really important issues. And I think we're going to deal with those by inviting some guests who specialize in those areas.
Right.
And that's what we'll be doing. So,
and we're also going to be having people that the cross between the healthcare and financial, the
yes,
relationship, and how close that is, because one suffers and the other suffers. If you have financial problems, and I can attest to this, if you have financial problems, it affects your health unbelievably.
Absolutely.
Yeah.
So what we've done here is we laid the groundwork. The investing groundwork is here. Maybe we'll think of other things to talk about. But these first 4 shows, I think, really establish the foundation that hopefully you'll want to stay tuned and keep on listening. But please take the time to watch our first 3 shows. You've watched this one. And we look forward to talking to you in the future.
Okay, we'll see you in a couple of weeks, folks. And thanks so much for watching. It was a great show, Ron. Thanks.
Thanks. Thank you.
Bye.